As we get started today, I want you to remember the number 15. We're going to come back to that in just a moment. But what we are going to be getting to today are a couple different aspects with respect to the economy and how things are changing. Then we're going to dive into your portfolio and some of the ways that we can be constructing things in order to take advantage of those changes. And then lastly, I have a couple key elements for some advanced planning strategies for your overall wealth plan. So as you can tell, we have a lot to get to. Let's dive in. That brings us to number 1, economic and stock market risks. Let's take a look at the current state of the economy. With everything that's been going on, there really is no major triggers for the stock market to be disrupted in what we call the flows, or the money either going in or out of the stock market. So what that means then is the logical move in the stock market really is a continuation of what we're already starting to see, which is of movement higher. So that is something that we're starting to, not only see, but actually start to think about more and more. But there is a however here. There's a significant divergence between large company stocks and small company stocks. Now this divergence is widening. It's something we've been covering over the last year, and it could actually be a very big tell of what the next move is in the markets. You see, if we have small companies start to really catch up to large companies, so these smaller stocks that start to move up, that's going to bring the averages and the indexes up, and it's going to be a continuation for the large companies to continue to keep growing. Now, this could be a very quick and violent move higher for small companies to catch up with large company stocks as well. The however, though, is that what if the reverse opposite is going to happen? What if large company stocks start to move down in price and going back to where the small company stocks are? That is something obviously that we're going to be keeping our eye on, but something to be of note when it comes to the overall stock market, because that will start to take down the overall stock indexes as well. Now, there's also however here with everything that we're seeing. We are witnessing right now a continuation of government spending that we have been seeing for the past about 4 years. Now this spending, which was really highlighted from the pandemic and really progressing now as well, is our deficit spending. Last year alone for 2023, we saw over $2 trillion of deficit spending, and what has already been projected for 2024 is that we will be at least coming in at the same amount, if not a higher amount, of deficit spending. So what does this mean? Well, think about it this way. When we take a look at all of the spending that's happening, that could be actually a very good thing in the short term, meaning it's a stimulus type of effect that we can be boosting our economy in the short term. In the long term, that may have some other effects. But for right now, we need to take what's in front of us and what we're seeing, and if the government continues to spend in the same manner, chances are that's going to be a boost to our economic growth. So that could actually be good news in the short term. So that is what we're actually seeing there. But there's another worrisome indicator that we're starting to witness as well. And that is something that we see generally a little bit more so as a telltale sign for recessions. Now this is also something that we need to be paying attention to, and it's what's called the inversion of the yield curve. Now this is where it gets to be a little sticky. We have seen this happen over the last year, that our yield curve is inverted. Now there's a difference between what we call the nominal yield curve and the real yield curve, and they generally move in sync. But right now, that's really starting to have another divergence. So that is also something that we're starting to see. Now what's the difference here? Now the nominal yield curve that we're seeing here, that's been something we've been talking about, something that really is a predictor of, recessions in general, but takes a little bit of time. Now think about it like this. What's the difference between nominal and real? Think about when you go shopping. The difference is the price that you pay before taxes and after taxes. So think about the nominal being what is before all of the different data points are there, and the real is being after the fact. So the real is actually something that we are witnessing starting to invert now, and it's just happened a month ago. So like when we are starting to talk about all of this here, the difference is just the ways that it's calculated. And it really suggests that a recession, and this is a little bit more emblematic of where we're at right now, that when we see the inversion of the real yield curve, that it actually is a very good predictor that could actually start happening in the next 12 months. I'm not saying it has to happen this way, but that is really something that has been a predictor in the past, and that would actually line up to a lot of the elements that are going on this year, not only with respect to having the overall presidential elections happening, but then coming back into what our presidential cycles happen. And coming into the first year of a presidential cycle generally is a little weaker point for the economy anyways. That coincides with what may happen in the future. So this is not going to matter until it does. So as of right now, like I said, the most logical outcome is for the stocks to continue the pace they're on and to continue most likely moving higher if there's no major events that happen to change that. Number 2, portfolio changes. Let's talk about some potential changes to your portfolio. First, as we've been noticing recently, we've been seeing a strengthening of the US dollar. And this coincides with a healthy economy at times as well. So you see how they're all coming together? Well, it may be a good idea to continue to change out of cash reserves and allocate more of that to the US dollar then. Additionally, consumer discretionary stocks are starting to really show signs of life, and we also are seeing signs of strength in economies as well. So Greece has been a great place with the shipping container type of stocks, and their country is very tied to shipping, so that we're starting to see some great elements there. The Philippines have been doing great jobs, even places like Denmark. Well, we also have India in there as remaining a strong economy. And what this all really shows us is that there are economies that are doing well, like the US, and there are economies that are not doing well either, like China. So when we take a look at all the different elements together, there may be good places to have your money invested today that we can exclude places like China, but maybe to what is actually going to be beneficial for you, include places like the Philippines or India. Now, also when we're starting to look at things, mid-size technology-focused companies are really starting to become attractive for investments as well. So what you're starting to see is that we're starting to have a broadening of areas that we have not seen before. So going back to some of the changes we're seeing with the economy, it may very well be that the small companies and the mid-sized companies that have not been participating may actually start to do that. And if that's the case, we will see a continuation of the stock market rally. So that's, again, all based upon risk tolerances as to what we're going to be invested into. But there are some very good places to come for your own wealth. Number 3, wealth management and advanced planning. I want to change today a little bit with respect to our wealth planning and focus on you as the business owner. Now, it's important to consider, especially when selling your company, some of the different types of buyers that are out there and that exist. There are 2 main ones that most likely you'll come in contact with. One is the financial buyer, and the second one is a strategic buyer. Now, it's important to consider which type of buyer is going to be right for you and your company based upon what ideals you have for your company and your intentions going forward. You see, a financial buyer is really going to be solely interested in getting a financial return, and they're going to purchase the company to do that. So they're going to seek an undervalued company and one that has significant growth potential. Now, most likely that this financial buyer will expect you to remain on as an active member of the business to generate the expected profits, as well as they're going to possibly inject money into the business and really engage in a financial restructuring. Now, this can be used as leverage when purchasing companies. So that's really what they're going to be focused on here. Now, on the other side though, we have the strategic buyer, and they usually are going to go after larger firms, and they're going to focus on how acquisitions can complement and enhance what they already own and the existing business that they already have. So then they're going to seek what we call a synergy. And the value that your company is going to be combined with theirs is going to be something that is going to be obviously different for each individual company operating on its own, but one that could be potentially very beneficial for you to join up with. Now, strategic buyers will pay more for a company then, due to the enhanced value that your company could bring to theirs. And that synergy that really happens could be very helpful for them. Now, it's crucial here, though, to weigh out the potential synergies that you have against risks that may be out there, and that could actually impact ones like your employees and your customers. Ultimately, the decision between the two, whether it's a financial buyer or a strategic buyer, is ultimately yours, and it depends on your goals and your objectives. So just like your overall wealth plan, this is your company. So take time to discern which one's going to be right for you, which one's going to produce really the highest value for your company, and all the other factors that we need to be considering. And that's where, when we can be helping you guide through the process and all the circumstances behind it, you may find one is going to be more appealing to you over the other. So as you have questions, we'd love to chat with you about which business sale and which buyer potentially could be right for you. Number 4, receiving a second opinion. I want to remind you of our second opinion service here. Now, we've talked a lot about your business, we've talked a lot about your portfolio and changes with the economy. Now, your friends and family really may actually want to be part of the same, and they may benefit from a fresh perspective on their wealth plan. We'll go through that discovery meeting. We're going to assess all of their gaps that exist and where they're at today and where they want to go in the future. Then we are going to be sitting down with them on a strategic meeting to go through 3 possible outcomes with them. First of all, they may be in a great spot and no changes are needed, and we'll let them know that. The second element here is that there may be a couple elements that need to be changed, and they can go back and do it on their own. The third element then, if you refer someone to us for the second opinion service, is that they actually may have a lot of information they need to be going through, ways that their wealth plan can be updated, corrected, fixed, gaps closed, and we'll let them know that as well. But no matter what, just know this: whether it's you that's going to go through a second opinion service with us, or whether it's one of your colleagues or close friends or family members, they're going to be in good hands by knowing that they're going to have the ability to help fix, correct, solve some of their gaps in their wealth plan and the ideas and strategies behind how to do that. So with that, if you know anyone or if you yourself would like to come through our second opinion service, please reach out to us and contact us about going through this second opinion service, and we'd be happy to schedule time to talk a little bit about that and then walk through what that looks like for you. So with that, I hope you enjoyed today. Now, that number 15, what did that really symbolize? Well, when we come back to the stock market, there's been 15 weeks that we've seen an increase in the stock market, and this has gone back to 1971 before we've seen this level of growth all at once in the stock market. So again, we are witnessing history. Take care.